They've given me the mic. That's a dangerous thing. Good morning, everyone. Good morning. I am Preston Jones, the Dean of H. Wayne Huizenga School of Business and Entrepreneurship, and I'd like to welcome the distinguished guests, faculty, and of course, the NSU Sharks. We are indeed honored to have our guest today, Mr. Ben Baldanza, CEO of Spirit Airlines. And, but before we bring him up, I'd like to take a moment to recognize our honored guest. I was looking for Dr. A. Fisher. Is he here? Dr. Fisher? We do have a couple of special guests here. Lauren Smith from, stand up and say hello, Lauren. She's already in there. Popcorn, stand up, young man. I'd like for the faculty in attendance to stand and be recognized, please. Dr. Poggioli, oh wow, this is great. Welcome, thank you so much. Now, yes, Ray Rodriguez. How are you, sir? You snuck in. Ray Rodriguez, member of our Hall of Fame. Member of the Hall of Fame. Now, as is customary at these events, I'm the one who would introduce Mr. Baldanza, but I'm going to ask a couple of NSU Sharks to come up and do the honor. Roberta and Nicole, please.
I'm Nicole, and this is Roberta, and we're going to tell you a little bit about Ben. So Ben Baldanza joined Spirit, the largest ultra-low-cost carrier in the United States, Latin America, and the Caribbean in January 2005. As the President and Chief Operating Officer. In May 2006, Ben was promoted to the President and Chief Executive Officer, at which time he was also appointed to the Board of Directors.
Ben has over 25 years of airline-related experience. Prior to joining Spirit, he served as Senior Vice President of Marketing and Planning at U.S. Airways, where he was responsible for route planning, scheduling, pricing and revenue management, marketing, sales, cargo distribution, and the international division. Prior to U.S. Airways, Ben served as Managing Director and Chief Operating Officer at Grupo TACA, an airline group based in Latin America and held various management positions at Continental Airlines, Northwest Airlines, and American Airlines.
Ben holds a Bachelor of Arts degree in Economics from Syracuse University and a Master of Public Affairs specializing in Transportation and Economics from Princeton University.
Let's give a hand to NSU Sharks, and they're also members of the Spirit team. Have a seat, please. Thank you so much. I would also like to say just a quick few words. I look for the definition of spirit, and I have just a couple of things to share with you. The meaning of spirit, a supernatural being or essence. A supernatural being or essence, spirit. The activating or essential principle influencing a person. Spirit. A special attitude or frame of mind. Spirit, enthusiastic loyalty, as we just displayed here with the Sharks. Spirit, a lively and brisk quality in a person's actions. And I'll tell you this, I had the privilege of visiting Spirit Airlines about a month ago, and what you see here from Nicole and Roberta epitomizes the spirit of this company. And I would like to bring to the stage, ladies and gentlemen, I'm proud to present Ben Baldanza.
Well, thank you, Dr. Jones, and thank all of you for spending some of your time with us for the next 60 minutes or so. Let me start by asking, for all of you who don't currently work for Spirit, how many of you have flown Spirit in the last couple of years? Wow, thank you all very, very much for that. And my guess is you all have stories to tell, hopefully some good, maybe some not so good. But what we're going to try to do today is explain our business model a little more, and maybe some things that didn't make sense to you when you flew us make sense now. Or hopefully maybe some things that made sense will be put in a different context for you. We'll have plenty of time for questions when we're done. I wanted to start with a quote from Sir Richard Branson, who said if you want to be a millionaire, just start with $1 billion and start an airline. And that, unfortunately, has really been the economic history of the U.S. airline industry. As recently as just a few years ago, the U.S. airline industry was a net negative industry, meaning the industry had lost more money since Orville and Wilbur first flew than it had ever made. And really, it's just really been over the last couple of years that the industry has moved into a profitable history since the early 1930s. The airline industry history is riddled with all kinds of ideas, many of which failed, many of which flew for some time and didn't. We had a big airline right here in South Florida named Eastern that doesn't exist anymore. Everyone can think about airlines that don't exist anymore. And now the industry has changed in a real dynamic way. Just 4 airlines in the United States, American, United, Delta, and Southwest, now control 85% of all the seats flown in the United States. And what that has done is it's created a more stable industry from an economic standpoint, but that means higher fares for consumers and generally less choice for consumers. And that's where Spirit comes into play, because what we are is we're an airline doing things quite a bit differently than the traditional airlines, and essentially creating opportunity for people who've been priced out of the traveling market to fly a little bit or fly at all, or some people, if they just want to spend money on their vacation and not spend money getting to their vacation, can save a lot of money with us. So our strategy is basically we compete solely on the basis of price. Many airlines, and if you look through history, many airlines have tried to compete by saying, I'm going to develop a certain physical product or maybe a certain kind of experience to say that's what I'm going to try to sell to customers, in hope that customer will choose me over my competitor or over another airline, or will choose me for more of their travel. And in Spirit's case, back in 2006, when we converted the airline to the airline we're talking about today, at that point, Spirit was following the trend of the normal industry. Since Spirit started in 1980 up through 2006, the airline had lost $350 million. And it really was only in business because individuals and then later private equity capital put money into the company to keep it going. And in 2006, we changed the business model to operate on the basis of price, to say we're going to compete for customers based on if they care most about the lowest price getting where they're going. That's how we're going to structure the airline. And why did we decide to do this? Well, it was based on a real detailed study of airlines around the world. We said, let's look at what's worked and what hasn't worked. So let's just not throw darts on the wall. Let's try to see what history teaches us. And what we did is we looked at each airline's long-term financial success, compared against, product features ranging from almost nothing to real premium, and product consistency across the portfolio, revenue of premiums associated with maybe doing certain things, if you offer more legroom, or maybe show movies, or fly internationally, and basically the fundamental cost structures and profits of airlines, both with and without fuel hedging. And the reason that's important is fuel is the largest expense that most airlines pay today. So we have to think about fuel in everything we do. So we came up with this little matrix, and we have this theory that anything in the world can be described on a 2x2 matrix. and so our 2x2 matrix is, if you think to the left, airlines that compete on a product basis. So they have real nice seats in the airplanes, real nice service in the airports, and so on. And then those that compete more on price, and you might think about an airline like maybe Southwest, maybe 20 years ago at least Southwest. And then airlines that have been consistently profitable, meaning they make money pretty much all the time, somewhat independent of macroeconomic environment, versus airlines that have been cyclically profitable, meaning they've made money in good times but given it all back and usually more in bad times. And what we noticed was there are some premium product carriers that weren't consistently profitable. Airlines like Emirates or Singapore Air or airlines like that have a terrific physical product. They don't get rattled when a low-cost carrier enters their market, or maybe another airline runs a sale. They invest heavily in their product, and there's a certain amount of the flying demographic that is willing to pay for that product, and they do very well. At the other end of the spectrum, you have sort of what I would call new breed low-cost carriers, which are really just two in the United States, Spirit and Allegiant. And then everybody else are what we call tweeners, which are legacy airlines like American, United, and Delta, and airlines that used to be thought of as low-cost carriers like Southwest and JetBlue. But what defines all those airlines is that their product isn't good enough to command a revenue premium 24 hours a day, 7 days a week, 365 days a year. Yet their costs aren't low enough to be able to be profitable by offering the lowest price in the market that will drive customers. And what it does is it creates a challenge for those airlines. And this is most airlines in the world fit in that bubble, which is why that bubble is so large, that they have to struggle with, what am I? Am I an airline serving corporate business travelers? But the reality is not a lot of corporate travelers fly on the weekend, and they fly at different times of the year, more and less. And so it's hard to sort of fill planes with that. So if you're going to fill with more discretionary traffic, but you're going to lose money on the margin when you sell at low fares, it's kind of a tough business to be in, which is why you've seen this push toward consolidation and why just 4 airlines control 85% of the space now. Because when oil went to $147 a barrel in 2008, the industry lost $10 billion in 1 year. Spirit made money that year, but the industry lost $10 billion. And that forced that consolidation to try to create a revenue structure in the industry that would compensate for the high costs of these carriers. And that's why consumers pay higher fares today. So this tweener problem is just what I said. Successful product-centric carriers, the Emirates, the Singapore guys, they know who their customers are, and they create a high expectation, and they deliver that high expectation. Price-centric carriers like us and Allegiant, we know who our customers are too. And we deliver a real low price, and we accept losing the high-touch customer. So we recognize that our product isn't for everyone, and likely isn't going to attract the higher fare-paying corporate traveler. We tend to think of our customer as customers who pay for tickets themselves. Because if you pay for a ticket yourself, customers tend to be more price sensitive. They tend to care more about what they're paying for the airline trip. They're thinking about their whole travel and how much am I going to spend getting there versus being there. And the tweeners just try to be all things to all people, and that's just hard because it's hard to be low cost when your costs aren't low, and it's hard to be high revenue all the time, and certainly on an entire airplane. And this isn't just in the airlines that this is true, but for some reason, it seems to be controversial when we apply this concept to airlines, because McDonald's and Morton's are both restaurants, right? And they're both successful, but would McDonald's be successful if they offered a steak for $35? Probably not. Would Morton's be successful if they sold $3.99 combo meals? They probably wouldn't either, right? And yet people don't think that that's weird, yet applied to the airline industry, they think it's weird. Nordstrom and Walmart are both retailers. Would Nordstrom go broke selling jeans for $9? They sure would. But how many $1,800 suits would Walmart sell? Not many, right? They're serving different customers. So in other things we buy, and other things consumers buy, cars, retail, restaurants, whatever, the concept that there are different segments of the market and there are different product-centric features and price-centric features exist. In the airline space, this is relatively new because for many, many years, all airlines competed on the same basis, and the customer expectation was every airline's the same, and I buy a ticket and I get the same thing on every airline. So we think that just like it's worked in other parts, it's working in our business too. And the reason it works is when you survey customers and you ask them what they care about. The survey was done by a group called Elliott.org. He is a consumer advocate, writes about travel. And he asked people, what do you care most about when buying your ticket? And almost 80% say they care about price above everything else. Much more than legroom or even the reputation of the airline service, or whether there's business class, or whether there's charges for things. And it's not like customers don't want those things. But any of you who've taken any marketing class know that there's a big difference between stated preference and revealed preference, right? What someone says they will do versus what they will actually do. Those are two big difference there. And the way customers behave is they tend to be motivated principally by price. So we've decided to build our airline to serve the number one thing that most customers care about, which is price. Which means we're willing to give up some of these other things, recognizing that the customers who do care more about that will choose to fly another airline. But that's okay. There's plenty of room for both. A lot of airlines. So clearly where we fit on this graph is on the far upper right. And I'm happy to say that we have been profitable since adopting this business model in 2007. We were profitable when oil went to $147 a barrel. We were profitable in 2009 when there was a major recession for business travel in the United States. And most tweeners saw unit revenue drops of double digits of over 10% on a year-over-year basis. But we don't carry a lot of business traffic, so our revenue was basically flat over those years. And we went public in 2011 and have continued to grow since that point and continue to sort of push that edge of this matrix. We like to think of this as we've gone from not to hot in 7 years. Right? So if you think back in 2006, for the full year, Spirit lost $81 million on $543 million in revenue. We served 30 airports, 31 airplanes, had unit revenue per ASM. The way to think about it in airlines, we're just a factory. And what our factory makes is seats that go places. So we measure our revenue per unit of product, which is a revenue seat mile, and we measure our cost per unit of product, our cost per seat mile. So we had our unit revenue of 97, 682 cost without fuel. When you add fuel to that, it was more than 937, so we lost money. And we had about 80 million in cash, and we collected $4.80 from people after they bought the ticket for other things, which in 2006 was basically overweight bags or liquor on board or things like that. Go to 2013, we made $177 million on $1.7 billion in revenue. So look at that revenue change from 543 to 1.7. We can thank Roberta and Nicole for that, because they work in our revenue department. We now serve 56 airports. We had 54 aircraft at the end of 2013, 56 as we're standing here today because we've taken delivery of 2 more this year as well. We served over 12 million passengers last year with a unit revenue of about almost 12 cents, $54 of which comes from things other than the ticket. Over 40% of our revenue base comes from things other than the ticket, which means our ticket prices are ridiculously low. We'll talk about that in a minute. But this idea that we used to be and also ran in the industry, and now we're leading the industry in terms of margin performance, in terms of growth, in terms of employment, and in terms of innovation. So if you think about this, our fares plus bags and seats, because baggage and seat options are probably the 2 biggest things that people think of as used to be included with your ticket and now aren't always included with your ticket. And our fare plus bags and seats is about $102, Southwest about $125, Delta $152, JetBlue $170 or so, American and United close to about $200. So we have very low fares, and yet we have a cost structure that allows us to make money with those fares, because a lot of the costs that these airlines carry are in an attempt to try to attract that higher fare paying customer. So they put fewer seats on their airplanes, or they have lounges in the airport, or they have service features that are expensive but that not everyone pays for. So we built the strategy to say, how do we have the lowest cost? So we keep the model really simple. We treat all customers the same. We don't have premium flyers and less premium flyers. We treat everyone the same. That makes our training very simple at the airports. It makes our technology very simple. If you think about it, if there are some customers that pay for their bags and some who don't, you need to train your agents to be able to recognize who those customers are and explain to the ones who pay why they pay and this person doesn't. You also have a system. You also have a system that allows you to print a bag tag whether there's a payment for it or not, based on who it is. That creates revenue leakage often, and that creates complication. So running things simply is a very good way to keep costs low in any industry. We also maximize utilization. So we maximize real estate on the airplane. We've got this little map of an airplane here. This is a Spirit A320 mid-size airplane made by Airbus Corporation. We put 178 seats on the airplane. JetBlue flies the same airplane, and they put 150 seats on it. Now, I don't think we pay any more for our planes than JetBlue, but if you say the airplane's about the same price, pilots are expensive, flight attendants are expensive, fuel's expensive, landing in New York or Fort Lauderdale is expensive, and those costs are all the same. So when we can spread those costs, those fixed costs over 178 people, and they're spreading them over 150 people, you can get an idea of how much lower our fare can be. Now, you're going to get more legroom on JetBlue. You're going to be able to watch TV on JetBlue, that's true. But with only 150 seats, their fares have to be higher. So if you're okay paying more for that legroom and that TV, that's great. That's like eating at a restaurant better than McDonald's, right? But if you want the lowest price to New York, or Columbia, or Las Vegas, or St. Thomas, or Chicago, or the Bay Area, we're going to be the lowest price option. We also optimize the variable component of our cost structure, so we outsource at stations when that makes sense. We insource when it makes sense for us. Usually when we usually start by outsourcing. If the volume grows, then we can be more efficient hiring our own employees, we will do that. We lease gates on an as-needed basis. We avoid long-term commitments unless we know we're going to be there long-term. And we have a very low-cost mindset. We think about things ways to eliminate and reduce costs or get somebody else to pay for it. We try to get things sponsored wherever we can. We have unit cost targets in our company down to individual groups. And when we think about incentive compensation plans for the company, a big piece of those plans are tied to us meeting our cost goals as well. And we also fly the planes more hours per day. You can see that we fly our planes almost 13 hours a day. JetBlue at a little under 12, Southwest a little under 10. And if you think about that big fixed cost of an airplane, that we can run the factory more hours per day, you can just get more utilization out of it. All those things help us have lower costs. So when you roll all this up together, we have a unit cost with fuel of just under 10 cents, about 8% lower than Southwest, 26% lower than JetBlue, 40 to 90% lower than the big guys. And that's really important. And not only are we very proud of this slide, but what we're even more proud of, I might say, is that over the next 5 years, we think this is going to look even better because we know what's happening to our costs. Maintaining flat or maybe even reducing a little bit while there's cost pressure at all these airlines. So if we were all to get back together here in a couple of years and show an update of this chart, I bet we'd look even better than this on this chart. And that makes us feel very good about our growth. And yet, costs only tell a piece of the story because we collect more after the ticket than any of our competitors. Our upfront prices can be dramatically lower. So we can break even at about $56 a ticket. That's on a 2.5-hour flight. That's pretty good. Right? So $56 we can break even. What that means is for the year, if we sold our tickets at $56.07 and we collected all the non-ticket revenue, so we collected all the bag fees and seat fees and things, that would make us a break-even airline. Obviously, we made money in the last year, so our average ticket price was a little higher than $56. It was actually around $80. But if you look at that, Southwest needs to charge 85% higher than us to be economically neutral to us, in part because their costs are higher, and in part because they don't collect as much after the ticket. They got to get it all up front. Bags fly free, right? So you pay for the bags whether you check them or not. That's their model. JetBlue has to price 147% higher than us in order to be economically neutral to us. Again, because it's nice to have legroom. It's nice to have TVs on board. It's nice to have free blue chips, but it ain't free. Right? American, Delta, and United have to charge 200, 300% higher than us. What this does is it allows us to control our revenues better than a traditional airline can. We tend to be the price setter in the markets we serve. Other airlines tend to decide, do I match Spirit's price or not, rather than us deciding, do we match this other airline price or not. Gives us a little more control of that. And if you think about it, we are participating in what you might call the commodity end of the airline space, the more discretionary traveler, someone who's deciding whether to take a trip or not, where price matters the most. And in any commodity business, the low-cost producer tends to have an advantage for the company. airplanes or corn or fuel. And yet what this structure does is it allows us in the a la carte approach to pricing, it allows customers to choose, and it puts power in the customer's hands. So, and it also drives low-cost behavior as well. When we charge for bags, check bags, and large carry-on bags, people carry fewer bags. That saves us fuel. It saves us infrastructure at the airport. When we charge to print a boarding pass at the airport, which we do if you go to a human being, but you can print it free on Spirit.com, or you can print it free at one of the many kiosks we've been put around most of our airports in the system. But if you self-serve, it's free, but if you go to a human being, there's a charge to it. The idea is that there's certain ways you can behave that are low cost to us. If you behave in those ways, you will not pay extra and you'll get the lowest possible price. If you choose to behave in ways that are a little more expensive for us, we'll give you those options. But we're going to charge you the difference rather than make everybody pay for your choice. So customers on Spirit pay for what they use and they save money on what they don't use. I referenced Southwest a little earlier with the bags spot free. The disingenuousness of that model, I believe, is that they're charging you for 2 bags, whether you check the bags or not. So if you check the bags, that's great. But if you don't, you should ask Southwest why you're paying so much in your ticket, because you're not stressing the bag out. You didn't require them to have that staff at the airport for your bag. What you're doing is subsidizing everybody else who did carry the bag. And at Spirit, we don't believe that subsidization is economically fair, and so we build the airline, you pay for what you use, you save on what you don't, and that lets people control their total price in a much bigger way than when they fly other airlines. This non-ticket revenue is just over 40% of our revenue. 2 airlines you may or may not know of, Allegiant Air, which flies mostly from small cities in the U.S. to a large destination point. They fly to Fort Lauderdale. They're known in the world to be pretty good at that, but they only get about 1/3 of their revenue. Ryanair in Europe, which really started this trend. Ryanair started a number of years ago after coming to the U.S. and seeing Southwest and saying, we can do this in Europe. But then they started the whole unbundling, and they're only at about 24% of their revenue. So we're actually best in the world with this non-ticket. And we were really pleased about a year ago when Ryan called us and said they wanted to talk to us about some of the things we were doing. And at one point, looking up to Ryan as a model and then having him call us was a real ego booster for us. Our strategy is basically to milk this model, if you will, and push this model as best we can. Stick to our core principles and continue to grow. Every decision within our company is driven by its impact to the bottom line. We ask ourselves, is this going to help us make more money or not? That's the right way to think about a business. Is if you're going to make a decision, is it going to drive more customers? Is it going to drive more revenue? Is it going to lower costs? Is it great stickiness of customers? So we don't chase revenue at the expense of unit cost. And what do I mean by that? Well, I'll give you a good example. We don't have Wi-Fi on our planes today. And you ask, well, why don't you have Wi-Fi? Don't people like Wi-Fi? Well, sure, people like Wi-Fi. But when today, the technology today in 2014 for Wi-Fi on airplanes is there's about 4 providers that offer it. And what they do is they sell the pipe to your airplane so that you can connect your tablet or your smartphone and do what you want to do online. But they charge airlines to install that pipe, about $50,000 an airplane. The antenna weighs between 70 and 100 pounds, which burns more fuel every flight. And then they don't really care whether people use it or not. Right? Those companies, the airlines may care. So what happens is a big airline that's competing for corporate travel installs Wi-Fi. All of a sudden the games change, and now I got to have Wi-Fi because now I'm at a disadvantage. So now everybody has Wi-Fi. Well, we don't have Wi-Fi because customers don't pay for Wi-Fi in airplanes. Not many do, and a couple do, and it doesn't make sense for us to do Wi-Fi because all it's going to do is raise our costs, and it's going to make us raise our ticket prices. Because we put Wi-Fi in the airplanes, we're going to burn more fuel in every airplane. We're going to have to cover the $50,000 incremental cost to do it. So we're not going to do it until there is a Wi-Fi company, and I believe there will be sometime in the next 5 to 10 years, who comes to us and says, look at Spirit, you've got customers trapped on your plane for 2.5 hours. We want access to those customers, so we'll put the Wi-Fi on your plane, and we'll collect money from them, and we'll give you a share of our revenue. When there's a Wi-Fi company that will do that, we'll have Wi-Fi on the plane. And I think that's probably going to happen in the next 5 to 10 years, but that's not the state of technology today. That's what I mean by not chasing revenue at the expense of costs. We treat all customers the same. We don't have any special waivers and favors. The single biggest customer complaint about Spirit Airlines is that we don't refund a non-refundable fare. I'm not sure exactly what people thought non-refundable meant, but everybody has their opinion about that. We sort of mock legacy thinking when it justifies a bad decision. Sort of one of the biggest insults you can give within our offices is to say you're thinking like a legacy airline. We got to have fun with that. And we think about utilization with a capital U. It's not just the hours per day that an airplane flies, but it's how we use everything. How we use people, how we use technology, how we use physical footprint at an airport, and so on. We have a single class cabin, even though we have larger seats in that cabin that you can pay incrementally to sit in. And we have a single crew fleet type, which makes it really efficient for us to train pilots and mechanics. Every decision driven by the bottom line also means we deploy assets based on the highest return potential. So we fly where it makes sense to fly, and we change flights and change deployment of airplanes throughout the season as things go. As you'd expect, more people come to Florida in February than come in July. So we fly more to Fort Lauderdale in February than we do in July. And we put the plane somewhere else in July. And we have no emotion around where we fly. One of the games we've played in our revenue team is when we look at, in the network side, when we look at performance of routes to decide should we fly more or less, we strip the names of the cities from them. And we just look at the numbers and say what needs more, what needs less, and you take the emotion out of it. It's a little game you play, but it's kind of fun. And based on demand, we serve markets either less than daily or seasonally, and we don't think about market share as anything that drives revenue premium. In fact, we don't even care about our market share. What's important is that we make money everywhere we fly, not whether we're 1, 2, 3, or 10 in any given market. That's kind of irrelevant to us. So if you don't think about market share, you're focused on economic return, single fleet type, single cabin, treat everybody the same, be very disciplined capacity, and more people fly when you have low fares. That's sort of the core principle. And we ask ourselves, if we do X, whatever you're asking, put in Wi-Fi, add more seats, put a lounge in the airport, whatever, will this lower our fare? And if the answer is yes, it'll lower the fare, then we investigate that further and say, how do we do it? If it's going to make our fares go up, we say, that's not our business. Let's go do something. So some of you have taken marketing classes. I don't know if they still teach marketing this way, but at one point in life, at least, you think about marketing as the 4 Ps: product, price, promotion, and place. And that's sort of the marketing equation. What we do at Spirit is we kind of operate in a world where product and price are almost the same thing. Our product is the fact that we can get you there cheaper than any other airline. And then you can get to Nicaragua for $69. And you can go see your friend at a baseball game in Chicago for $79 when it's $150 or $200 everywhere else. And the promotion works because low fares sell themselves. We spend 0.3% of our revenue on advertising. Most airlines spend over 3% on advertising because low fares sell themselves. When you have the lowest fare, people find you and people search you out. Customers are very smart. They want to save money and they find us, so we don't have to promote as aggressively. What we have to do is just make sure we have low fares. And in terms of where we sell, customers search out our low fares, so we can be picky about where we sell. Now, we sell today on our website, we sell at a call center, we sell through online travel agents like Expedia and Travelocity and Orbit. But the reality is if you buy from anywhere other than Spirit.com, which is our lowest cost of distribution, as a customer, you're going to pay $10 more for your ticket to buy there because it costs us more. About a third of our customers buy us that way, and that's fine. But I was telling a story a little earlier today. Back in 2006, we pulled out of Expedia. And for 7 years, we weren't in Expedia. Expedia at that time represented 3% of our revenues and 25% of our distribution costs. It just didn't work for us. So we kept selling through Travelocity and Orbitz because our contract with them worked a little better. And basically just about a year and a half ago, Expedia came back to us and said, Spirit, we want you in our system again. And we said, well, here's the way we work with you. We're going to sell lower on our own website than on you. You're going to charge an extra $10 for us. And that's the way it works. And they said, okay, we'll do that. It's an hour on Expedia. So we can play that game. We can have more control over our own distribution when we have the lowest fares because customers who sell travel want to have that low fare option at that everybody flies us, but you want to at least have the option. Imagine if you lived in a city that only had expensive restaurants. You might be happy that a fast food restaurant opened up. Not because you want to eat there all the time, but it's nice to have the option. So this business model drives very high margins. On a pre-tax margin basis for last year, we operated at 17.1% margin. That means every dollar we collected, we kept 17 cents of it. Allegiant, also a very good model, 14 cents. Alaska, not a lot of competition. Ripe for picking for any of you who want to start an airline, go to Seattle. It's 12.4 cents. Southwest Delta and United and the rest of the world, well under 10%. So the financial returns of this model are proven and work very, very well. That's why investors like us. This is where we flew in 2007 when this model started to be placed. Obviously, a lot of flights out of Fort Lauderdale and continuing growing flights into the Caribbean, Central, and South America. Now this is where we fly, and all the Fort Lauderdale flying is still there, and it's even bigger. We now fly to 4 cities in Colombia, more cities in Central America, more cities in the Caribbean. But Dallas is now our second largest station with almost 40 flights a day. We have a number of flights in places like Minneapolis and Chicago and Las Vegas and Southern California, and it's working. The business model works in a lot of places, and the same environment which has made the industry more stable, which is consolidation and higher fares, has created a beautiful palette for us to paint on in terms of being able to fly into big cities with a lower fare approach. And this is all great, but can we grow? Well, we sure as heck can, because we have no debt on our balance sheet and just over $500 million in cash. That lets us finance airplanes very efficiently. That makes people who want to, as any of you who think about finance know that banks don't lend money to people who need it. They lend money to people who have it, right? And so having cash helps us finance our airplanes more efficiently, and airplanes are another big piece of our cost structure. When we can finance airplanes more efficiently, our costs go down and our ticket prices go down. This is the most complicated chart on our slide, but I'm sure any good shark can understand it. What this is the left side shows the revenue per seat mile, so the unit revenue on a route, and the bottom shows how long the route is in miles. So as you'd expect, on a per mile basis, you pay more for shorter trips on a per mile basis than long trips. And what this bar shows is in our cost structure, how we earn that sort of 15% kind of margin. And what the green dots are is their city pairs or a nonstop service that we don't fly yet. And we don't fly them yet, but we know how many people fly, and we know how much they pay, and so we lower that unit revenue by 25%. And if the dot is still above the line, we know we can fly there, make our margins, and yet still provide a much lower fare option. So let me give you an example. In this particular dot, goes from A to B, 356 people are flying it every day right now. It's 407 miles long. Their break even, people are paying $162 each way. There's real data. Government collects the tickets and does a sample, and you can buy this data. And our break-even fare in that market would be $40. So we can enter that market. We can grow the 356 to probably close to 500, fill an A319, which has 145 seats in it, and charge $80. And by charging $80, that's what's going to make 356 go to 500, and yet we can make a really good margin because our break-even is only $40. Let's look at this one, a little longer, a little bigger market, a little longer haul. It's 1,100 people are flying it every day today, and we don't serve it. It's over 1,000 miles long, and they're paying $247 each way to fly it. We can break even at $101. So let's enter that market. Let's charge $150, $160. That 1,100 is going to go to 1,500. Put 2 flights a day in that market. And every dot looks like that. Filling all these dots would take us 150 airplanes more than we have today. We've got about 100 on order. What that does is it lowers the risk of that growth. We're in the first inning of our growth. We're not in the 6th inning or anywhere close to the 9th inning. And if you think about it, it's not that different from where Southwest Airlines was in the early 1980s or where Ryanair was in the early 1990s, with a lot of growth in front when they were small and still had that cost advantage. So with over 500 large unflown high markets, take more aircraft than we have on order to serve all these. So investors love this chart because what do investors buy? They buy return and growth. That's what the only two things you really have to tell an investor is what's your return on capital and how much you're growing. And if your return on capital is high and you're growing, investors are interested in your stock. And so investors like our margins and they like the growth potential. So our airline changes a lot of the rules from what used to be traditional. We have the lowest total price, meaning the fare you pay plus the extras you buy, the total is lower than another airline. We help more people fly and help people fly more often. We are proven profitable in a lot of different economic environments. We have the lowest cost and the highest margin among our competitor base. We have very strong demand for our product, driven by those low fares, and a lot of growth opportunities. So it's a win-win for our customers and investors. And how about you guys? You want to work at an airline like this? If you're smart and you're aggressive and you're willing to work hard and you're willing to buck the trend, then we want smart people. So hopefully some of you will think this is right for you. We're really glad we're going to call it and Deanne. And so thank you very, very much for listening, and we're happy to take any questions.
Ladies and gentlemen, first of all, sir, thank you very much. All my economics students, and I see some of them in here, should recognize the power of economics. This is a clear class of economics today, folks. You never understood it when I taught it. I hope you understand it.
It's funny that you say that, because we were interviewed not too long ago by NPR's Planet Money program, and they did a little thing on us. And one of the two people said, this is an airline that an economist would create. And I said, you're right. And the other one said, but people hate economists. So I thought that was kind of funny.
Ben, obviously Southwest and Ryanair both started with similar models.
Mm-hmm.
Where did they morph into what they are today versus what you are?
Well, Ryan is still pretty much pure. I mean, Ryan is larger now, so I think their growth opportunities, it's hard to grow 20% when you're already 300 airplanes and add 60 planes a year. That's just hard logistically to do. So Ryan's at a slower growth rate, but they're still pretty low cost. Southwest is a little different. What you've seen in Southwest and what you've seen in JetBlue and some other airlines is airlines that have compromised their business model from what initially made them successful. The 1980 Southwest wouldn't have paid millions of dollars to buy slots at Reagan National Airport, that Southwest just did. They wouldn't have a code share with other airlines that they do today. They wouldn't be flying to places like LaGuardia and Boston and congested airports and things like that. They wouldn't have done that, but as they got larger and as they couldn't grow as much and as their costs got higher, they needed to search for higher revenue sources, and that's why they've become more of a legacy airline today. In JetBlue's case, the first 5-6 years of JetBlue, they were a pretty profitable company. Then they bought a different airplane type, the E190, that really complicates your pilot training and your maintenance, but they wanted more revenue, said we can serve smaller cities with this airplane. They signed a whole bunch of code shares in New York, which brings you traffic, but it's a very expensive way to distribute your product. They signed away their distribution rights, so JetBlue sells on Expedia and Travelocity and Orbitz and everyone else, but the fare there is exactly the same as on their website, so what's the incentive to use their website? There's almost none, and yet they save money when people use their website. So they've compromised their business model from the initial success point. One of the reasons we're most bullish about Spirit, and one of the things we're most proud of, is that we've got a lot of growth without having to change what we do. It's going to be a long, long time before we need to think about those kind of solutions for new growth. That chart with all the dots tells you we've got 10 years of growth in front of us. Just as Southwest did. If you could go back in time and invest in Southwest when they had 50 airplanes, you'd have done really well from airplane 50 to airplane 200. Or the same with Ryanair. They're just older. I mean, I'm 52 years old today. My body can't do what it did when it was 19 either. Right? You get older and things change and you have different things happen. And so we're a younger company with more opportunity, we're more nimble, and the market rewards that with growth.
Thank you.
You mentioned Southwest quite a bit. And I look relative to core competencies. What would keep Southwest from saying, there's really nothing keeping us from just going back to the good old days, because we knew how to do it. We probably still know how to do it. What would keep them from going back and being a direct competitor in your field if they felt like it? Doesn't sound like with JetBlue, they have different infrastructures and different costs, but it seems like Southwest could could get rid of a lot of that pretty darn quickly and compete.
It's that's directionally kind of right. What that misses is the fact that they're a 30-plus-year-old company now with fairly senior labor. So the average captain at Spirit is about 8 years senior with the company, and our average first officer is about 3.5 years senior, 3 years senior. What that means is it's going to be 20 years before our average captain is, it's going to be a long time before our average captain is 25 years with the company. And Southwest has 25-year captains and 18-year votes. And it's hard. That creates a cost infrastructure that's hard to cover. The other thing is when you're 700 airplanes like Southwest is, you're not going to add 140 airplanes every year. And that's what it would take to grow 20%. So your airplanes are getting older. Your labor is getting older and more expensive. And yet you're not able to average that down by growing and adding new labor, new airplanes and such. So they're at a point in their growth that just makes it hard. They certainly could unbundle their product more. They could add more seats. They could say, I'm going to fly more hours per day. They could certainly do all that stuff. And that would make them more like us. But they would still fundamentally have a cost infrastructure that we will have 30 years from now also. I'm not saying this is a 50-year model. But it sure is, it's really good 10 to 15 years.
We have a question here.
Yes, I have a question. My name is Gracie. I work here in accounts departments. I oversee the student accounts. Normally we bring a lot of speakers, and I work with the travel office all the time. And we use Spirit quite often, and the only problem that I have, because I never have any problem with Spirits. I travel myself and I like it. It's very cheap, very competitive, and now everything makes more sense to me. But the problem is when you bring in a speaker that you send him the ticket online, and then when he's trying to get his boarding pass, they're asking you for to create an account. And then if you try to get in hold with somebody, and I know somebody here knows what I'm talking about, if you're trying to get in hold with somebody, it's not a person, it's not a phone number in the website, you can't get in hold with anybody. I cannot create a profile for any speaker that comes to NSU to speak or to, you know what I'm talking about? Is there any other way that we can get the person to do the boarding pass without creating a profile in a Spirit?
I'll tell you why we do that, and it's consistent with the model that we operate. It's important that if customers fly us, that we know who they are. And so we ask for the email and the name. That's all it takes to do the profile, is the email and the name. It doesn't take an address, it doesn't take anything else, just an email and a name. And if you want to avoid that, you can go to a human being at the airport, and you're not asked to do that, but that's a $10 charge. So there's a way to do it, but it costs more to do that because it's cheaper for us if you use our website or you use our kiosk, but it's going to ask you for the email address. That's why we do that. What's that? And on certain itineraries, it can say continue as guest, and you can do that and not have to do it. But some fares don't allow that, and some do. Yeah. And so basically, it's important that we have the email of the customers. And that's why we do it. So they can go to the airport, they'll get their boarding pass, but they're going to pay $10 more. Just put an email address in, and that's all it takes to set up the profile. It's pretty easy, and we can have someone help you out with that if you want.
Next question over here.
Hi, my name is Chad D. I'm a student here. And my question was, your model seems to work very well here in the United States. But like Ryanair in Europe and I think there are a few others in other countries. Do you have plans to expand Spirit Airlines in other countries like Brazil or China that would provide a much lower cost than other airline tickets?
It's a great question, and there are, we're not the only airline doing what we're doing. Ryanair does this in Europe, an airline called AirAsia does this through a lot of Asia. There's an airline in Mexico called Volaris that is a domestic Mexican airline that is trying to emulate what we do a little more and more. There are lower cost operators in Brazil that only operate within the country of Brazil. Right now, we operate from the U.S. to foreign spots in the Caribbean, Central, and South America. Our legal authority as an airline, as a U.S. certificated airline, in most cases doesn't allow us to fly inside a foreign country the same way British Airways can't fly from New York to Florida. They can fly from New York to London and Florida to London, but they can't fly New York to Florida for the same reasons that stop Spirit from flying from Bogota to Lima, for example, or from Mexico City to Guatemala City. So in order to do what you're suggesting, which could make a lot of sense, it's higher risk over the next couple of years than growing in the domestic United States, where the travel is more stable, where you understand the environment really well, and where the fares are really high, and customers are thirsty for low fares. Right? But it's high risk. But you certainly could. But what it would require is setting up a different company certificated in that country. So to fly within Mexico, you need to be a Mexican carrier. To fly within Colombia, you need to be a Colombian carrier. And at some point, maybe there's a Spirit Holdings that owns the United States Spirit that does what it does, and a Mexican Spirit that says it's going to be in Mexico, and a Chinese Spirit that's going to be in China. But that would be a longer-term view of growth. But certainly the business model approach makes sense for everywhere in the world. I mean, the only way this model doesn't work is if you find a country in the world where the customers don't care about low fares. If that's true, this model won't work.
Next question is right.
Oh, I'm sorry.
Good morning. My name is Jay. According to you, the ultra low-cost carrier model is extremely successful. And how do you anticipate the emergence of a new ultra low-cost carrier in the U.S.? For example, say like Frontier is trying to do the same thing. They're trying to do the ancillary revenues eventually. Do you have any comments on like another successful one is going to the United States?
Yeah, it's a good question. In any product, whether it's an airline or whether it's an iPad or anything else, products that are successful create copycats. That's true. And it would be foolish for us to think that with the kind of returns we've been able to create and the kind of growth we've been able to create, that other airlines won't try to emulate what we do. I absolutely expect that over the next 5 to 10 years, you'll see more airlines looking like Spirit than like other airlines because we're more successful financially than other airlines, so that's what people will copy. That's a reality. We got to live with that. The way we live with that is keep our costs really low. The last place a new entrant low-cost carrier would likely fly is against us because they're going to go pick off some of those green dots before we get there. That's what they would do. That would be their margin positive sort of thing to go do is say, well, Spirit can't grow that fast. They got 150 airplanes worth of growth, and they can't get 150 airplanes in the next 2 years. So we'll get the last 50 dots before they get there. That's what we do. We could do something like that. Let me give you sort of a benchmark. The European Union air travel market is about 95% of the size of the U.S. in terms of the number of people who fly every day and the amount of seats invested in or deployed. Within that market, Ryanair on their own, which has been operating long enough and does have clones, but Ryanair on its own has over 300 airplanes and serves almost 11% of that market. We operate 56 airplanes and have just 1.5% of the market. So our belief is that the absorption rate for this kind of business model in the U.S. is probably 500 airplanes. Now we're going to get to 143 by 2021. If I can get to 500 economically efficiently with proper risk and train all the pilots and that, we would do it. But it's hard to grow that fast. And so the reality is there's going to be clones and there's going to be room for the clones. That's the real answer to the question.
Yeah, my question is, I know the dean explained what Spirit means, but how did that title come about for this airline?
Well, it's a good question. Sometimes sometimes you start a poker game, and sometimes you step at a table where the game's already being played, right? And when I joined Spirit in 2005, and when we adopted this business model in 2006, the company had been operating since 1992 as a scheduled service carrier with that name. So the original owners of the airline named it Spirit. I'm not exactly sure why they chose that name or what that name meant to them. But at that point, we saw the airline as a set of assets. We have airplanes, we've got positions at airports, we got this name, we got $480 million in revenue that's coming in. for something, and we said, how do we make all that better? And how do we make it profitable? And how do we look at benchmarks around the world and look at patterns of business behavior around the world to choose best practices? And at that point, it seemed risky for us to change the name than to create a new name at that point. So we kept the name, and I'm not exactly sure why the original owners created it, but we like it because we think it means a lot of the things that Dean Jones read it. And we think that applies to us.
Right over here.
I have a question. I heard you guys are getting about 100 new airplanes to target those green dots. What kind of airplanes are you guys getting? Because I heard that this other airline, when they bought the Embraers, they gain another cost because they have to train the pilots and all that.
Yeah, we fly the Airbus A320 family. The A320 family in size is sort of comparable to the Boeing 737 family. And both airplanes, Boeing makes 737, Airbus makes A320, and they make the A320 in 3 sizes. So they make the A320, which in our configuration holds around 180 seats, 178 right now. You take a section out of the fuselage and shorten it up, and it becomes an A319, put 145 seats on it. You take the A320 and you add another section in the tube, and it becomes longer, and now it holds 220 seats. And yet, it's the same engines, it's the same cockpit, it's all common parts, so a pilot can get off one and fly the next on his next trip. So we fly the Airbus A320 family today, and all the planes we have on order are the A320 family.
And how come the one over there was 737-800?
Which one?
The one in the presentation.
It wasn't our 737.
Yes,
No.
737-800 both.
Because the person who picked his pictures didn't know the difference.
That's
No,
an A320.
No, the first one.
This one?
No, that's an MD-11. But the one on the first slide.
That's an A320.
No, with those wingtips.
That's an A320 with sharklets. All the A320s we find now come with those sharklets. Airbus calls them sharklets, Boeing calls them winglets.
Yeah.
But since 2012, that's how the A320 looks.
Oh.
Yeah, it makes it 3% more, and they put that on there. It was a good call though to notice the sharklets. And but that makes the wing about 3% more efficient, burns about 3% less fuel on a 2,000-mile haul. If you fly from here to Orlando, those just add weight. If you fly from here to Las Vegas, they save you money.
Is there a significant difference between the cost of a gallon of fuel for you versus the larger carriers that are going through it at higher volumes, obviously buying fuel in a higher volume capacity?
Not really. We, as a buyer of fuel, we buy pretty competitively, and we buy enough fuel that we're at a pretty flat part of the curve. So, even though American buys a lot more absolute fuel, just in volume, they don't pay a lot less than we do. We tend to buy all of our fuel, or most of our fuel, from the Gulf Coast. And the Gulf Coast, as a fuel market, is about 2% cheaper than the East Coast or the West Coast. So we get an advantage that way. But our real big advantage in fuel is that we put so many seats on the airplane, is that we burn less fuel per seat. So on a per seat basis, we burn less fuel than any of our competitors. And what that means is in a volatile fuel environment, we can recover increases in fuel more quickly and more completely than our competitors. If the price of fuel between New York and Florida goes up such that it costs $200 more to fly from New York to Florida, we can spread that over 178 people, and because our non-fuel costs are lower, maybe we only need $2 a passenger. But other airlines with higher costs and fewer seats might need $5 a passenger. So their ticket price has to go up, which means that in a higher ticket price environment, our model becomes even more competitive because the price gap between us and the other airline in a higher price environment, we can have a bigger price gap. Now, the prices are in absolute higher than they would be in a lower price environment. But the higher prices go, the more people will consider saying, I'll sacrifice the leg room, I'll bring my own book to read. I'm not going to pay $400 when I can pay $250.
Next question is okay.
My name is Husni. I'm a junior here. I study finance, and I'm pretty excited like what I heard today from you. So it's my very pleasure to hear that. My question is related to the supplier. You guys use Airbus, which is located in the European Union. while you guys can use Boeing instead and lower your costs, since you're talking about lower costs?
There's a presumption there that it would be lower cost for us to use Boeing. We don't think that's true. We know what Boeing will sell us planes for, and we know what Airbus will sell us planes for. That's another case of sort of this poker game, entering the poker game midstream. It is very expensive to operate different fleet types. Because as I said before, you have to train the pilots differently, you have to have different spare parts, you have to train mechanics differently, and so on. And so at the time I joined the airline and time we converted this model, the airline was already invested in the Airbus airplane. So it wasn't practical to think about buying the Boeing airplanes back. That said, we're very happy with the Airbus plane. And just like the Toyota or the BMW you may buy, airplanes, Boeing may be based in the US and Airbus may be based in Toulouse, France, but the airplanes are made all over the world, and the wings come from one place, and the tail comes from someplace else, and the body comes from someplace else, and the engine comes from Connecticut, and so the percentage of the plane that's made in America is exactly the same as the 737. And starting in 2016, they're going to assemble this plane in Mobile, Alabama. So it's as American as a Boeing plane is, even though the company's not headquartered.
I've flown your airline a number of times. So,
Thank you.
In the beginning, though, thankfully I did my research, so I knew what to expect. But I can imagine when I'm at the airport, you have an amazing staff and customer service philosophy, so I have to say that. And my mother was a corporate travel manager, so I was trained to spot those things. But I could always tell the customer who probably booked through an alternative method, because if you go through your website, it educates the consumer on the upfront costs versus airport costs. And so how do you go about continuing that education for somebody who's utilizing an Expedia or Travelocity, so that when they get to the airport, their fabulous staff doesn't have to educate them on the fly?
It's a great question. It's a very insightful question, and it's a very real-time question, because we're wrestling with that exact issue right now in terms of how do we better align the customer expectation to the reality. I have joked in the media multiple times that no one goes to McDonald's and is surprised there's not filet mignon on the menu. Right? You know what you're going to get. And what we find when we look at our customer data and we look at what customers say about us, good and bad, there's a huge difference between customers who understand the model and who bought from our website versus customers who are flying us for the first time and didn't have that education in terms of what their expectation is. If you expect that I'm going to pay separately for my bag and then I'm going to pay for anything I get to eat or drink on board, you feel differently about it than if you're surprised by that. So last fall, we hired an agency based in Kansas City called Barclays to help us with that. And what we're doing is what we're going to be rolling out as early as next month, and in fact a little bit of it has already started rolling out, is a combination of team member training and different scripts and different signage to help better educate that customer. Customers who understand us like us, or they don't. And if they don't fly us. But if they understand us, they like us, and they get it, and they're not offended by the things that someone who buys Spirit but is expecting Delta gets. So about a third of our customers today fall in that group of the sort of aren't clear what they bought, and then we see it's our job to educate them before they get on the airplane. And we're taking a lot of steps now in terms of changing our training, changing our signage, changing the way we talk about what we do. And for those of you, again, who are maybe studying marketing, some of you may know that we tend to run hopefully humorous, sometimes controversial kind of fare sales when we run them. And we try to, make fun of politicians who screw up, or athletes who screw up, or things like that. And that's worked very well for us, because what it does is, on a viral nature, what that does is have people get the email and they send it to their friends and say, can you believe what this airline did, or isn't this crazy about that? And we realized that we're pretty smart about being able to get eyeballs and get people looking at us. But for many, many years, we were provocative on purpose. But now we're thinking about it being provocative with purpose, as opposed to provocative on purpose. Provocative with the idea of helping to train people. So we might, we have ideas, for example, at the airports, where maybe, I'm just making this up, I'm not sure we're going to do this, but you might have a sign that says, first class, business class, and both of those are crossed out, and it just says smart class.
Yeah.
And again, just simple kind of things you do that. We've created videos that help explain, that help people understand how you can pack more smartly to save money on Spirit. And we could send that video with your confirmation email. So you buy a ticket, and then you get the confirmation, thanks for buying us, watch this little video, and maybe save a little money on your bags, and those kinds of things.
Because if you get like the upgraded seats, Vegas is the market I'm most familiar with, but for $450 round trip, you can get a first class experience on Spirit that would cost you $1,200.
That's right, you just pay for it all incrementally. That's exactly right. Yeah, I don't like it when people call us a no-frills airline. We're not no-frills at all. We're just frills for a charge. You can create a legacy kind of experience on airline, but you're going to pay for the differences incrementally. The difference is you don't have to do that, and you can spend less.
Thank you.
Oh, sorry.
Just have one more question. We'll be the last one.
Sure.
Which either way. Okay, thanks.
With someone, like myself, with a family that flies Spirit for cost reasons, where does safety come into your mind?
Safety, we talk about safety as safety always. We're a very safe airline, and we are overseen by the FAA in the United States using the exact same regulatory procedures that they oversee much larger airlines, called Part 121. That's the part of the Federal Aviation Operating Authority in the U.S. Congressional Code that we operate under, Part 121. And as a Part 121 carrier, the office that oversees us, which is based here in South Florida, audits us, has to approve our maintenance plan, they approve that what you're doing is going to keep the plane safe, and then they audit us to make sure we're doing what we say what we're going to do. And that's what the whole FAA job is. And there's there's certain antes, if you will, or to being a company like this, and by operating in an unsafe manner, that wouldn't be smart business for us either. So we can be low cost and be very, very safe. We fly very modern airplanes with a lot of technology. We have really good mechanics who are well trained, who have good tools, and that's not keeping an airplane safe and flying safely isn't what makes expensive airlines expensive. Distributing their product inefficiently makes it expensive. Trying to create a physical product that makes them inefficiently use their real estate makes it expensive, but not being safe.
Our last question.
My name is Roosevelt Jean-François. First of all, I'm one of your customers who like your service.
Thank you.
That's number one. I travel regularly to Haiti, but every time I have an opportunity to travel, I always see at the airport some of my people having issues because most of them don't have access to internet. Either grandma have their kids or son buy them the tickets and they did not buy baggage and so forth. And I would like to follow up with that question regarding education. Haiti may be a good market for not only you, but for other providers. So in terms of education and marketing, what is being culturally competent to address the Creole Haitian market, Mr. Bandiz?
It's a great question, and it's Haiti is a terrific example of how Spirit has really disrupted the airline environment and created a really different product. Before Spirit started flying to Haiti, we started that in 2008, I believe, or maybe 2007. Before we started flying to Haiti, if you flew from South Florida to Haiti, your options were pretty much on American Airlines or Air France 3 times a week, right from Miami. And the round trip average was $700. Haitians in Haiti earn about $700 per year on average. It was absolutely ridiculous. Our average price to Haiti now is around $99, $119, $89, something like that. And what it does is it's just created the option for many more Haitians to go back and see family or friends or to travel to the U.S. or so on. And yet, because the market is not there's not a big penetration in technology yet, the education there is all going to have to take place, or more often have to take place, at the airport itself. And a lot of the efforts that I talked about in the answer to that question are going to be at the airport. And we know when we fly to Haiti, and we know the times that people queue up, and we can do special things for that group so that they understand where they're getting in. The reality is, when you take our fare to Haiti, and you charge for the bags that the people flying Haiti are going to carry, it's still demonstrably less than their next best option out of South Florida. So it still ends up being a positive thing, but it is that jolt when they're not expecting it. You're exactly right.
Thank you.
Professor Baldanza. I have a question for you. And I say the word professor, the title, sincerely. Today you've given us a lesson in marketing, in finance, in economics, accounting, strategy, but also in leadership. And when I visited with you, I was taken by your culture and how important it is, and the team that you have, and a few members are here now, that embody what Spirit is all about. Can you comment a bit about your culture and your values and what really makes all this work for you?
Yeah, thank you, Dr. Jones. We're proud of the fact that we hire really smart people, and it's people are very often the difference between a business being successful or not being successful, and they're often the difference in a way to differentiate your company. And at Spirit, we don't think about putting lots of people to solve problems. We think about having smart people that can solve problems. And so we recruit pretty intensively. We test people who are coming into work for us. We do diagnostic testing and use personality profile testing and IQ testing, things like that, depending on the position. When we started putting testing in our pilots, for example, we used to hire 7 out of every 10 pilots that applied to the airline. We now hire 4 out of every 10 pilots. Right? The 4 we would have hired before, but now there's 3 we screen out because of things we learned that are harder to learn from an interview. So we do a lot of things that we're trying to be smarter about that, but we're growing, so we're hiring people, and in fact, I would say that the culture within the company, you might want to ask Roberta or Deanne or Nicole what they think, but we think it's a fun place to work, and we have a good time in our office, but we work hard too, and we measure ourselves against results, and we're proud of the fact that we have strong results, and it bugs us when we miss a cost target or miss a revenue target, but we celebrate success when we do well, and we have a fun time doing it. We like working with each other. The reason I'm not wearing a coat and tie today is this is how I dress when I go to work, and I thought it was better to show you what we are than dress it up. All right, so it's I can wear a coat and tie if I'm asking people for money. But we have a fun culture, but it's a work hard, play hard kind of culture. And as we grow, it becomes a real business challenge too, though, because Spirit hasn't always been the success that it is today. And there were times in the formation of this model, in the 2006 to 2008 timeframe, where liquidity was very constrained, where a company's ability to make payroll was very constrained. That created disciplines in the company to survive and to be profitable in a real hard time that are really good for us, even though times are better now. And yet when we bring new people in and they don't necessarily understand why it's so important for us to be low cost in this, or why did we remove 2 out of every 3 light bulbs in every light fixture in the building, and why do we do crazy things like that? It's because it matters to everyone, and maintaining that culture as you grow becomes a challenge in of itself.
Well, as the Director of Investor Relations, I am wearing a suit because I'm hoping that one day you may all be investors. But the culture at Spirit, I joined 3 years ago before the IPO, and it's really exciting to be there because we're morphing into being a large company from a very small, everybody come to work, maybe the hours weren't always defined and stuff. People always worked hard, but we're putting processes in place in order to reward our employees now. And I think that's a very important part. Is we're going to triple our business over the next 3 years, and we need energetic, smart people to join our team. and we're putting the tools in place to get those. So I've really enjoyed being there.
So when we were going public, we had 5 banks that supported us. That when we went public, big investment banks tend to have research analysts that cover certain industries. So I called the 5 analysts who covered the airline industry of the banks who were supporting us, and I said, we're going to need a really good investor relations person. Who should we hire? And all 5 of them said, you should hire Deanne Gable from Continental. So I called Deanne, and I said, Florida's a lot nicer than Chicago, and you know you're going to have to move to Chicago if you keep that job. And fortunately, she came and talked to us, and we talked her into coming here, and she's been great. So thank you. Thank you all very, very much for your time, and I really appreciate speaking with all of you. Hope to work with some of you in the future, too.
And before you leave, we have something for you. And on behalf of the H. Wayne Huizenga School of Business and Entrepreneurship, the Sharks, and all of the Shark family, would like to present this plaque to you. Thank you so much for all that you taught us today. And we're looking forward to a long and mutually beneficial relationship with Spirit Airlines and your wonderful team.
Thank you very much, Dr. Jones.
Thank you very much, and please come up if you want to talk to Mr. Ben Baldanza individually. Yes.
Thank you.